Okay, as we start with the short-term liabilities here in Connect, I'm skipping now up to number 3. We got borrowing $200,000 cash towards the end of in November, and going into the next year, a 90-day note. So a 3-month note, 9% interest. Now the really thing that I don't really like about the book problems like this is when I do a 90, I just say 3 months. It makes it so much easier. 3 out of 12. 90 days, you've got to actually start counting them up. So November, this is where you've got to have your months memorized and be able to add these up. So we got November has 30 days, December has 31, so now we're at 61 days, and this is a 90-day note, so that means there's 29 days left. You always count the, you never count the first day. I should go back on that one then. No, whenever you have a loan, you never count the first day, but you do count the last day. So technically on this one, November would only have 29 days. 29 days, and then December will have 31. So 31 and 29 is 60. So then we got 30 more days in January. So by my count, this would become due January 30th. Because again, you don't count the first day of a loan, and then you do count the final day. So that's when the loan is going to come due. 90-day, 9% note, $200,000 face value. All right, so let's go down here and start filling in the chart. Principal says, okay, what's it worth? We're telling it it's worth 200,000. The rate is 9%. The time total through maturity, so it is 90. It is let's go back up here and make sure. 90-day note. So we got to find 90. And then total interest. So let's calculate that up. 90 divided by 360. I always like to work backwards. Times 0.9% times 200,000. So total interest we're going to pay is $4,500. Now what it's having us do in this little chart is before we get to the journal entries, it's going to go ahead and have us figure up how much interest did I owe in 2017 and how much do I owe in 2018, because it's broken out over 2 years. So the first part is we added up November and December. There was 29 days in November, not counting day 1, and December had 31, so that's 60 days. So I'm going to go ahead and we're going to show 60 here. And then my total interest, let's calculate that out. 60 divided by 360 times 9% times 200 grand. $3,000 out of the $4,500 was earned in 2017. And in January, all we have left is 30 days. And I can just do the math here. I could calculate it out, but I know if 3,000 was in the last year, that means I still have 1,500 left for this year in 2018. Now I'm going to use these numbers. So I'm just going to have to scroll back up and down, but it's not that bad. 3,000 for interest that is due in 2017 and 1,500 for the following year. Okay, so we come down here, we're going to record the issuance of the note. So remember, we are the one getting the note. So we're getting 200 grand cash and simply just calling that a note payable, 200,000. So the first journal entry is very easy. Now, at the end of the year, I need to show that I've accrued interest. Even though I don't pay it yet, I need to put 3,000 on my books to go for the year 2017 and then show that since I'm not paying it, that I still owe $3,000. And then finally, we're going to record payment of the note of maturity. So I'm coming up here and I'm showing, okay, I need to get rid of my note payable for 200 grand. I need to show that I paid off last year's interest, 3,000. And I need to show that I'm paying this year's interest of 1,500. So that's where these two numbers come into play. And then finally, I'm paying back with cash the entire $204,500. Okay, this next one, this is a good, that has a good overview of a lot of the different payroll taxes and having caps involved. So remember back to my lecture, I told you that the book, they're not expecting you to memorize the FICA or any of the percentages. They're going to go ahead and give it to you. And they're going to give you the cap. So depending on which version, if you're in the summer 2020, then yours is going to look like this number. If you're in a future semester, your amount here will be different. That's going to be really the only difference in these problems. The Medicare rate, remember there's no cap on that. FUTA and the SUTA rates are given, and they say that both of them are capped at 7 grand. And so all those caps are going to come into play with one of our 3 employees. So what they give us here is 3 employees, A, B, and C. Employee A hasn't worked that much. They've only earned $6,400. And they are due payment of $800 for this next payroll. Employee B, what they're due and how much they've made, and then employee C, it makes a lot of money. They've already earned $112,000 this year, and they're getting paid another 8 grand this pay. So what we're going to do then is figure out how much payroll taxes need to be taken out. And you can see they've broken this down, employee A, employee B, and C. Okay, so for employee A, how much, for FICA purposes, how much of the 800 do I need, am I going to be taxed on? And that's basically asking, are we going to hit a cap? Are we going to hit this cap if we take 800 plus the 64? And the answer is nowhere near it. So we're just going to be taxed on the whole 800. And then the next one says, go ahead and fill in the tax rate. Well, that's 6.2%. And then they're going to figure, then they're just going to do the calculation for us. It says, okay, that's how much needs to come out of the employee's check. Now Medicare has no cap. So no matter what they've made, it's going to be the full 800. And then Medicare is 1.45%, which they give us. Now, when we come down to FUTA and SUTA, this is where cap comes into play. The cap is 7,000. If I add 800 plus 6,400, I'm going to go over that cap. So then what I have to do is focus on this number and the cap and say, if I'm at 6,400, how much more do I have to go until I get to 7 grand? And in between there is only $600. So I don't want to tax on the full 800. I only want to do until I get to the cap, which is $600 more. The rate for FUTA, 0.6%. And then finally, FUTA and SUTA have the same cap, so that's going to be the same 600 here. And it tells us the SUTA rate is 2.9%. Now, when we come down here, let's go ahead and for our next individual, they have already went way over the FUTA and SUTA cap, but they're nowhere near the Social Security cap. So for the they made 2,100. So I can put in the full 2,100, 6.2%. It went ahead and just pulled that down. That was nice. Medicare, 2,100. Now for FUTA, if I add the 18.2 plus the 2,100, I'm way over the cap. I'm already over the cap here, over the 7,000. So how much tax I'm paying? Nothing for FUTA and SUTA. Now for employee C, they're way over the FUTA and SUTA tax, so those are going to be zero, just like employee B. For Social Security, though, I'm getting really close. If I add up 8,000 plus 112,200, I'm going to go over the cap of 118,500. So then what I have to do is figure out how much is left in between. So I take the high number, 118,500, and then simply subtract where am I at now. And that's going to give me how much I have left in between those two distances. So instead of taxing 8,000 for Social Security, I'm only left with 6,300. Medicare, it has no cap, so I'm going to tax the entire 8,000. And then finally, FUTA, nothing, and SUTA, nothing, because I'm way over the cap. So we can check the work. Okay, looks good. Now, for part 5 and 6, they're going to ask us about employee A. So I'm just going to get a sheet of paper here, and off to the side, I'm going to write down these amounts. I'm going to write down Social Security at $49.60, so I don't have to recalculate it. Medicare $11.60, FUTA $360, and SUTA $17.40. So for this one, they want us, oh, we're gonna have us put it in again, which is fine. Assuming situation A, employee A, prepare the employer's September 3rd journal entries to record salary expense and its recorded payroll liabilities. All right, so they're gonna, basically, they're kind of having us do the same thing as we did before. So we're figuring out how much do they owe. It's telling us, like I said they would in my lecture examples, they're telling us the federal amount that's coming out, $80. They just go ahead and give it to us. Remember, for employee A, we're nowhere near the cap. All 800 is taxed. Tax rate 6.2%. And then for the Medicare portion, no cap. So the full 800 at 1.45. Now we can come down here and do the journal entry. So we're going to record the employer's September 3rd journal entry to the salary expense. So we're just doing part 1 on this problem. And we're going to do the second journal entry in number 6. So we got our salary expense for the $800. So that's how much they owed. Now I got to take out all of the taxes. So the first one they gave us was the federal income taxes. That one was $80. So that comes out of the paycheck. And then we've got the FICA. I always like to do them in order. I don't like to put them in any order. I'm going to do Social Security. And that was $49.60. Looking at my little notes, I could scroll up. And then I had the FICA Medicare for $11.60. Now, it's telling us that they didn't pay it. This was accrued. What that tells me is they still owe the employees. We then call this salaries payable instead of crediting cash. And we're simply just going to take then the 800 that I owed minus all of the taxes they're taking out of their check. So $658.80. And that looks good. Now we're ready for part 2 of the journal entry, the employer's part. So they're having us go ahead and calculate the 4 things that the employer has to pay. So they still pay Social Security, same as the employee. They pay the Medicare, same as the employee. Now, they also pay FUTA. And remember back the FUTA, we're not going to pay all 800 because we're going to hit the cap. We only have $600 left to the cap. The FUTA rate is 0.6%. And then the SUTA rate is the same wages, $600. And the SUTA rate is 2.9. It's telling us that all of the taxes, it will go ahead and add them up for us. So that's going to make it easy for us to do our debit. Because remember on our lecture example, I put in XXXX because I don't know what all of those added up to until I did it. Well, here they go ahead and have you add them all up. So it's 8220. So when I do the part 2 of the journal entry, I do my payroll tax expense for the payroll tax expense for the 8220. Then take out those 4 items. Social Security was 4960. Medicare was 1160. FUTA, let's see, federal unemployment, they don't abbreviate it for that. And that was $3.60. And the SUTA, state unemployment, was $17.40. Everything looks good. All right, here's the warranty one. Remember back to the lecture example, you want to do the warranty based on the percentage that is estimated, just kind of like doing depreciation as an estimate, doing the allowance for doubtful accounts as an estimate. This is an estimate as well. So we sold a copier. It cost us this. We sold it for $6,000. Cost us $4,800. We did this back in 2017, and then a whole year later, in 2018, we go ahead and make repairs. They cost us $209 in repairs, taken from the repair inventory. Based on this, based on their prior sales, they say 4% of all of our sales is going to come back and be a warranty expense, an estimate. So just on this sale, we're going to have a warranty expense. We sold it for $6,000, and we're going to do the journal entry in just a few minutes. But my warranty expense that I need to put on, I'm going to estimate $240 of warranty. And then it says, well, how much liability do I still have at the end of 2017 of estimated warranty? I haven't used any of it yet, so I still have all $240. And then it says, well, how much expense do I calculate for 2018 when I actually go in and do the repair? Well, I've already expensed for that machine back in 2017. So I'm not going to expense any more. I already expensed it. I'm simply going to take away from now from the liability to pay off of that expense. So it says the actual amount was $209. I had estimated $240. So it's saying, how much do I still have in that estimated account if I had $240 and now I've used $209? I have $31 still left in that estimated account that I may either use on this client if I need to, or carry it over to another client who may have a more expensive warranty. Now let's go ahead and do the journal entries. This is just like what we did in our lecture example, where we're going to record the sale, the cash sale. So I'm getting cash. They don't say anything about sales tax. So I just put it in as simply our sales. And record part 2, the cost of goods sold. And that was $4,800. Taking it out of our merchandise inventory. Now we're going to go ahead and record the warranty expense for the year of the sale. And that was $240. Warranty expense $240, and credit that estimated liability, estimated warranty $240. And then finally, now we're in 2018, we need to record the cost of that $209. Well, I've already expensed it. I'm going to then take it out of that estimated liability account, 209. And instead of crediting cash, I'm just going to take it out of my materials for the repair parts. So repair parts inventory. So this company has 2 different types of inventory, the regular merchandise and then the parts. And there we